Good afternoon, good morning, good evening to everybody. My name is Richard Kozel-Wright. I'm the Director of the Globalization and Development Strategies Division here in UNCTAD. Welcome to the 2022 UNCTAD INET YSI Summer School. This is our fifth school and the third in a virtual format. And let me just start off the bat by thanking colleagues who have put in the hard work to get us here. From the UNCTAD side, I have to mention Ursula, Maria, and Gaul, and from the INET side, Heskey, Claire, and Jay. These are the invisible hands that really do work to deliver an efficient outcome, and I thank them all profusely. I also want in advance to thank all those who agreed to give their time as lecturers and moderators over the course of the coming week. As we begin planning for the school, there's usually a kind of deep breath that we take as we think about the theme to frame a series of hopefully topical and engaging lectures. I think the breath was somewhat shorter this year. In previous years, we've discussed many of the inequities and the crises and policy missteps that have persisted since the global financial crisis, in large part because economic orthodoxy is ill-suited to deal with many of the structural asymmetries and systemic fragilities that characterize contemporary capitalism. But what COVID has done, perhaps because it forced policymakers to privilege the health and safety of citizens over the profit motive of corporations, is to widen the debate about policy alternatives, and in particular whether the current international economic architecture is fit for supporting a more ambitious policy agenda. Hence this year's theme of challenges and opportunities of a new international economic order seemed rather to pick itself. Of course, a key challenge facing any discussion of a new economic order is whether we will undertake the big investment push across several sectors that are needed to build a more sustainable and inclusive and resilient economies. And by implication, whether we put in place a financial system that can underpin that kind of push. We certainly didn't after the global financial crisis. And so when thinking about a keynote lecturer to kick off the school, there was a very swift agreement amongst us to ask Pardee Mehrling to address this issue, and Pardee very promptly and very graciously accepted to do so. And we are very thankful for him to be here today. Pardee has been researching and teaching money and finance for most of his career, a long time at Columbia University, and more recently as a professor of economics at Boston University. And Pardee is also on the academic council of INET. So a real perfect fit, I think, to be a keynote lecturer today. I'm not going to try and summarize Pardee's voluminous outputs on these issues. That would be impossible, and we don't, unfortunately, have the time. Just to say that he has an enviable grasp, not only of the internal plumbing of financial markets and financial institutions, but also of the different strands of economic theorizing about the financial system and its links to the so-called real economy, as well as the policy challenges that have emerged with the evolution of our contemporary credit-based and highly internationalized financial system. I should just say his latest book, which I think came out last month or a few weeks ago, is a biography of Charles Kindleberger that I personally really look forward to reading as a fan of Charlie Kindleberger's work. And I think, I'm sure, because Kindleberger's work was very much engaged with the rise of the dollar-based international system, it's perhaps something of that volume will seep into his presentation and lecture today. After the presentation, we will take a few questions from the audience, 10 minutes or so after Paree's lecture. So if you have any questions, please click on the Q&A button and add them to the Q&A. So without further ado, it's a great pleasure to welcome our keynote speaker, Perry Mehrling, Professor of Economics at Pardee School of Global Studies at Boston University, who will be discussing a money view of the emergent new international economic order. Perry, the screen is yours.
Thank you very much, Richard. I'm very pleased to be here, pleased to be invited. It looks in my background as if I'm in Geneva, and I hope that perhaps next year I will be. I am not in Geneva, but we'll pretend we're all in Geneva right now. So let me just share my screen and get right to it here. Just a moment. Get that going. All that working fine. Speak now or forever hold your peace. Okay. So yes, I am. Let me just make that a little bit. There we go. So I put there in red, Emergent. Okay, that I'm going to be talking today about what the world looks like. Okay. What are so you might want to change that. You might not like how the world works, okay, but it seems to me that the first prerequisite for changing the world is to study it, is to understand how it actually works right now, and what its fragilities are. So that's what I want to talk about today. Money view. So money view, those of you who have, many of you, I'm sure, are aware that I have an online course, a MOOC that INET created, Economics of Money and Banking, where I'm trying to propose a way of an analytical framework for thinking about the modern monetary system that I developed over all these years when I was teaching at Barnard and Columbia. It's now 10 years old. It was 2012 when it was filmed, but I think the principles are still accurate, even though maybe some of the facts have changed in the last 10 years. I want to say that the money view is, I mean, as Richard sort of signaled, it is an alternative, or rather, maybe I would say a complement to standard economics. Which tends to abstract, and also standard finance, which tends to abstract from issues of liquidity, thinking of them as frictions, and analyzing a frictionless surface. When I say money view, I also want to make sure that you understand that this is not the money view of Milton Friedman, as opposed to the credit view of Bernanke. It's in fact opposed to all of them. So you'll see that it is an attempt to put forward a third view. The key elements, which we're going to see again and again in the next 40 minutes, are two, okay? Thinking of the economy as a payment system, which is not as an equilibrium system, but individuals are making payments to each other, and the system as a whole is coordinated by settlement. So the requirement to make a payment is a moment of stress in the system for each individual, a stress that can be relaxed by the money market, by borrowing, by not settling, by not paying, but rather by pushing that payment into the future, that we call funding liquidity. All of that element is basically abstracted from in standard economics and finance. So but that is put front and center, okay, in the money view. The second idea is to think of the economy as a web of promises to pay in the future, okay? So these are future cash flows and cash commitments. Some of these promises, which are financial assets, are priced and traded in the present moment, so their prices fluctuate, but it's not a supply and demand system, okay? There's a centrality of dealers. Dealers are on the other side of these trades, who are offering trading options to buy or sell, and that's the source of market liquidity. So again, dealers in this framework, who are abstracted from in standard money and standard economics and finance, are front and center in the money view. So these are the two kind of main ideas. So that's just a brief introduction to the money view. And you'll see these ideas. If you really want to master these ideas, as I say, there's the MOOC and there's lots of other stuff on my website. That's what I teach actually at Boston University. Richard was anticipating that I might be channeling Charlie a little bit, and so in fact I am. Here is the what the book looks like, Money and Empire. And that's him there. That's the picture that was taken when he was president at the American Economic Association. His presidential address is there, 1985, International Public Goods Without International Government. The most important international public good for him was, in fact, international money. And we'll come back to that. So it's a biography of Charlie Kinderberger, but it's actually intended to be also a story of the rise of the global dollar system. And it's had various ups and downs, but it has gone from strength to strength, as I'll share that presidential picture over his left shoulder, just a little blurry there, is a book, Can It Happen Again? That's, of course, Minsky. I think this is a posed picture. So I will be channeling Charlie and trying to think, what would Charlie say about the modern system 40 years later? And if he actually had, also studied modern finance and knew about derivatives and all that sort of thing. His intellectual formation is pre-World War II, so it's not that's not the world that he actually came from, but it's the world that we live in, and so we need to update it for the present. So New International Economic Order is also in the title. So I just want to remind you, in fact, Richard was saying that he thinks that the COVID has given us a chance to really reflect on what kind of an international order we want and how we might improve it. The moment when NIEO sort of came onto the scene was another moment like that. Okay, here I'm showing you that the resolution 3201 and 3202. It's worth looking at and seeing what this program was that was proposed by the countries of the Global South in the 1st of May 1974. It came on the heels of the end of Bretton Woods. The 15th of August 1971, Nixon gave a speech called "The Challenge of Peace." And I have a quote from that speech that I think is maybe relevant for what comes after. He says we must. So this is the President of the United States protecting the dollar by taking the dollar off of gold. That's what he is claiming to do in that speech. And his enemy, interestingly, is the international money speculators. So that's the thing that created the opening. I have provided to the organizers here, so I'm moving down to the third bullet point here, an article that Charlie Kinderberger wrote in 1978, the 40th anniversary of the Marshall Plan, which he was involved in creating. The OECD and the Third World. He's commenting here on the NIEO, and he is sympathetic to the aims of the NIEO, but he is also concerned that the program that they're proposing is in many ways sort of unrealistic and impossible, and trying to suggest how a better way of improving the international economic order. Perhaps that's what I'll be doing today too, trying to channel Charlie Kinderberger. And here's a quotation from that article. He says, "The one public good which the developed world seems to be unable to provide is international money." So that will be my epigram maybe for today's talk. I want to warn you right up here at the beginning that the framework that I'm going to be presenting, the historical account of what's happened since in the post-World War II period, departs from standard accounts, which almost all of them, whether from the Global South or the Global North, sort of take the key founding moment to be Bretton Woods, 1944. And I want to join with Harold James, the historian at Princeton, in pointing out that this is largely mythological, okay? That the notion that the international monetary system was somehow created by an act of benevolent multilateralism in 1944 is a myth. Perhaps a useful myth, something that it's helpful to believe. It makes people get along better. But if we really want to understand how the system works, we need to pull away the fabric of that myth and look at it much more clearly. So here's Harold James. He says Bretton Woods was the intellectual sugar covering and masking the bitter taste of the pill of realpolitik dollar hegemony. So that's for the recipients of dollar hegemony, the sugar, but also provided a sugar coating for the unpleasant taste of internationalism in the domestic context of American politics. So it served to function for America as well as for the rest of the world. And that function continues, has a long legacy. Okay, I will be saying that the analytical frame for standard international economics, the kind of thing you would have learned in any PhD program or even undergraduate economics, by which I mean maybe Triffin, I mean maybe Mundell Fleming, that accepts the myth largely. Okay, and so does the language of the critique of the international system, from the global South. And I want to say a few words about that. So I take as my sort of text for thinking about the critique this wonderful book by my former colleague Ocampo, 2018, and he makes very clear that his critique of the international system starts from a governance frame, imagining that the international monetary system was created by a political treaty at Bretton Woods. Anything that's not created by a political treaty is illegitimate from this point of view. That was a multilateral, everyone agreed to it, and except the United States never lived up to it. This is the kind of frame that there was also, even at Bretton Woods, a little battle between the forces of good, Keynes' Bankar Plan, which was going to create some symmetry, and the forces of U.S. hegemony, Harry Dexter White. And ever since then, whenever we reformed it, it's been a project of elite multilateralism, not full multilateralism. And this is a critique because it should be. There's a notion that sort of the system should be agreed upon by everybody in some big conference, and we vote on it. It would be democratic. That political frame shapes the entire conversation, and has done, I think, since 1974. From an economic point of view, another consequence of the Bretton Woods frame is thinking about each country as a separate little island that are interacting with each other through the current account, largely through trade. So there's this kind of neglect of capital flows which was certainly right. I mean, that's true about the world at the time that Bretton Woods was created. It was in the aftermath of World War II and also global depression that had collapsed the global capital flows. But that got embedded in the way people thought about the international monetary system. And it's, as I will say, it's a bit of a problem. And the notion that therefore balance of payments means that on average exports should equal imports, that there shouldn't be any capital flows, really, at least not net. Net foreign investment balance is zero, would be sort of the goal. And Ocampo goes on to say that the problem with the international monetary system right now are these imbalances driven by export-led growth strategies of the South, which force deficits on others, and reserve country, i.e. the US, deficits from the North, which force surpluses on others. He imagines the way to improve the system is to get everyone to come together and to agree to cooperate macroeconomic policy. So you probably know this stuff. I'm just reminding you of the standard frame coming from the global South, which I'm now going to query in a few ways. So here's a summary that one way of thinking about the standard global South discourse is that there are two big bogeymen: the hegemonic US, which is a neocolonialist power, and the international financial speculators, which are destabilizing the international system, and we need to attack those bogeymen. That is backing up a little bit and maybe looking more at the economics than at the politics here, and saying, well, let's look at how the global economy actually works, that it's a hierarchical dollar system, and think about the challenge confronting countries in the global south, which are a little far down that hierarchy, in managing their interface with that global system. That's the challenge. That's the frame that I want to explore today, putting aside this issue of the two bogeymen. I put there, just for completeness, a suggestion that maybe a lot of the problem of the global south are the problem of local elites, who are global elites. But I'm not a political scientist. I'm an economist. So the things in red are what I'm going to be talking about. Here's the alternative kind of history that emerges from a money view framework, understanding the Bretton Woods not as creating an international monetary system, but rather as a kind of this sugar political endorsement of the emergent key currency dollar system. That after Bretton Woods, the main building that happened in the international monetary system was the U.S. recycling its surplus to Europe as a deficit area in general, not paying too much attention to the global south. So the IMF took that on a little bit. And here are some key that Kindleberger emphasized a lot: the Anglo-American loan, the Marshall Plan, and then various kinds of NATO and so forth, that these are the mechanisms for recycling the surplus. This is what is creating the international dollar system as a Europe-US sort of system initially after the war. In 1958, finally, European currencies returned to convertibility, and the whole atmosphere changed. And the notion that that the dollar was going to be the global currency came into political challenge in the United States. Okay. The notion that New York would become what London did before World War I was not agreed upon by domestic elites in the United States, and so there were a lot of obstacles put in its way. And these, again, this is Kindleberger pointing this out: 1963, 1965, 1968, and so ultimately the Nixon devaluation in 1971 is about trying to abandon dollar centrality by the U.S. Trying to abandon dollar centrality. But the markets had a different idea. Okay, dollar centrality did not go away. Okay, it actually developed outside the U.S. The offshore dollar markets, the euro dollar markets took off, and ultimately the U.S. then said seems to have accepted that. That's how you understand Volcker, as sort of accepting, okay, the U.S. is going to be the apex of this system, and then this agreement between the major North nations in 1985, stabilizing that dollar system. So this is all actually Kindleberger that I'm telling you, channeling Kindleberger. But beyond that, so here's now bringing this a little bit up to date. Okay, so the story of Kindleberger's life is about the evolving dollar system to join the U.S. and Europe. Here, I'm quoting this picture is from an article by Bob Macaulay, a student of Kindleberger's, and Ito from the BIS, a key currency view of global imbalances, where they're sort of arguing that the evolution of the dollar system went through 3 stages. Okay, after Europe, the next stage was to bring Asia into the fold of the global dollar system, and then since the global financial crisis, it's actually been the global South. And so now we come to the main topic. Okay, I want to understand the global dollar system and the role of the global South in that. Since the global financial crisis, the expansion of credit in the global system has been largely in the global South, and it's been largely in dollars. Okay, so this is the emergent new international system that we need to understand. Here's a kind of maybe image to help understand the international hierarchy of money today, that the US dollar is at the apex. It's the key currency. It's a dollar system globally. That it is the global north, the euro, the yen, the Swiss franc, the British pound, the Canadian dollar. There are these swap lines between central banks. I'll say some more about that, which link those currencies in with the dollar. And then below that, there are other other more minor, so-called minor currencies in the FX lingo, which are linked in more loosely. And there's a new FEMA repo facility. I'm going to say some things about that. So it's a hierarchical system. The global south is rather far down the hierarchy, and so the challenge of linking in is what I want to focus on. So here's just some facts, okay, to have in mind. I said that the expansion of credit since the global financial crisis has been in the global south, and it's been in dollars. So here's some facts from the BIS about that from 2015. Dollar credit to emerging market economies. I'm sure this is too small to read all these countries, but these are all global south countries, and you can see all the graphs go up. So this is non-financial dollar credit. US dollar credit to selected non-bank borrowers, and it's uniform. It's pretty much every country. Sometimes it's bank loans, sometimes it's capital markets, but it's always up. I want to show you another piece of another fact, okay? This is also a period in which the global south has been increasing its dollar reserves, stock of dollar reserves, not just China, okay, but the global south in general. So borrowing in dollars, but also lending in dollars, you know, accumulating dollar reserves. And we could, and here's another from this is actually some BIS people, but they're publishing at the Banque de France. The shadow banking comes to the emerging market. So what I'm talking about here is capital market lending on the right-hand side of that screen. That's the first slide I showed you, where non-financial corporations are borrowing in US dollars from the global capital markets. And the money market funding part, I'm showing the central bank in these emerging markets accumulating US dollar reserves. And I'm just linking them together, saying that that is shadow banking. Shadow banking in my interpretation is money market funding of capital market lending. And you can see that the emerging markets are in both businesses. They're doing money market funding and they're doing capital market borrowing. And let's the system as a whole. So the left-hand balance sheet there is a Emergent international system where you have emerging market economies borrowing long-term in dollars, okay, and lending short-term in dollars, reserves, okay. That borrowing is largely from Asia insurance companies, banks, and so forth, which are funding it in term dollar markets, meaning 3 months, let's say. And that is being largely from Europe, French in particular, which are lending dollars, but also then borrowing overnight. And to some extent, that borrowing overnight are the reserves being held by the emerging market economies. So this is a little bit of a round trip. It's a different round trip than the one that fell apart in the global financial crisis. That was a round trip between the US and Europe. This round trip is entirely offshore, okay? Or it's connected to offshore, but there's a lot of it is offshore. And so the question is, how is this backstopped? There's a key role in the private market of foreign exchange swap hedges because, of course, Asia is really getting most of its funding in yen, okay, and has to swap into dollars in order to hedge the currency exposure. And Europe is getting most of its funding in euro deposits, and it has to swap into dollars in order to cover its exchange exposure. So the geography of dollar funding of non-US banks requires this backstop of private FX swap hedges, which is I'm showing you here. So this is the cross-currency basis against the US dollar, and those lines, one of them, the blue one is US dollar versus yen, the red one is US dollar versus euro. So these are the key funding markets, all funding markets in the global system, and they're backstop in the first place by these FX swap markets. I'm showing just the equation for covered interest parity there, F over S equals 1 plus R over 1 plus R star. And all of these graphs are shown as deviations from covered interest parity. This is for economists among you. You may know, particularly even if you've taken the MOOC, you know that in the MOOC 10 years ago, I took covered interest parity as a fact about the world, okay? This graph is showing deviations from covered interest parity, Okay, deviations, which are, you can see, 100 basis points, 70 basis points. These are very large deviations. Okay, it looks like riskless arbitrage is failing. Okay, but what is being priced here, I would argue, is in fact liquidity risk. It's not riskless arbitrage. It looks like riskless arbitrage from the standard economics and finance view because they're abstracting from liquidity. Okay, but the markets aren't abstracting from liquidity. They know that this is a risk. They learned it in 2008. You see that vertical bar, that's the global financial crisis. In 2011, that's the Euro crisis. And in the COVID crisis more recently. So this is the global system, and this is its vulnerability, and this is its backstop. This backstop was partly put in place during after the global financial crisis. These C6 liquidity swaps for where the Fed is providing 50 basis points around covered interest parity to the Bank of Japan and to the ECB, so that if their own banks require dollar funding, they can go to their central banks, which can go to the Fed. That was created during the global financial crisis as an international lender of last resort. That's that second line that I'm showing you there. Using here, there's an image of the trainer model of the dealer system, which I don't have time to explain, but this is just it's a key. This is an attempt to actually put some analytics on understanding the centrality of the dealer system, as I said, we do in the money view. The new piece of this international lender of last resort was put into place because of COVID. Okay, in July 2021, we created the FEMA repo facility, which allowed anybody with a treasury bill, anybody, any monetary authority in the globe, collateral for acquiring Federal Reserve deposits, which are the international means of payment. So this is at the moment, this is where we are in the evolution of the international monetary system and where the global South fits into it. Okay, that they now have, if you have a treasury bill, you can go to the Fed and get dollars to meet your balance of payments. And that is being tested. All of this stuff is going to be tested right now as we're tightening money in the global north, and that discipline is reverberating around the globe. First with crypto, but already with some payment problems in the global south. So here is a slide that's about the sort of contrasting to the Ocampo 3 points that I made there. Okay, that in the money view, the international monetary system emerges not from multilateral negotiation politics, governance, but from market practice, from currency do they want to borrow, in what currency do they want to lend, in what currency do they want to invoice their goods, and so forth. And in a globalized economy, there is big efficiency in having one currency that everyone chooses, okay, a key currency for efficiency. That emerging dollar system, according to in the money view framework, was endorsed, not created at Bretton Woods. I said that before. And the emerging Eurodollar system, the offshore dollar system, was endorsed, not created at Plaza, 1985. So not a governance frame, okay, but a market practice frame. Secondly, it's not an islands frame. It's thinking about the international monetary system as a unified thing. There's one money market. There's one capital market. Everyone is participating in this. It is, however, a hierarchical system, and there are other features of it, which I'll talk about a little later if I have time. But here's the point I want to really emphasize: that it's not that the way the international system works. We focus. Capital flows are integral to its operation, okay? And so as opposed to the Bretton Woods frame, where you're imagining that it's islands and everyone is sort of on average exports equal imports, there are short-term capital flows to buffer balance of payments problems, and there are long-term capital flows for economic development. The central problem, and here again, I'm channeling Kindleberger. For him, the central problem faced by the global system after World War II was facilitating long-term capital flows to the development of the global South. This was a problem that was perennial, and it was never really solved in his lifetime. And that inadequate long-term capital flow, in his view, created structural deflation in the North and structural inflation in the South. And inadequate long-term capital also meant that developing countries often use borrowing short for long-term purposes is courting a problem, because that short-term capital comes due before you can pay it. And so that's the explanation for the crisis vulnerability of many of these countries, is the inadequacy of long-term capital flows. So here, just what are capital flows for? Long-term capital flows are, in his view, are about economic development. And there's a life cycle here that young debtors are borrowing in order to develop their countries. Mature debtors are repaying. Young creditors are lending. Mature creditors are liquidating. In the global system, you have some of each of these things. That's the ecosystem of the global system, where you have young creditors, mature debtors, etc. I'm showing here the uses and sources accounting, where these countries have their balance. So that this is another way of thinking about the world that we use a lot in the money view, the uses and sources accounting instead of GDP accounting. So that is, again, just kind of signaling the different approach of understanding that world. Here's another image. Somebody who heard a talk I gave on finalization and discontents tried to summarize this account by saying, what am I suggesting? I'm suggesting that the institutions of financial society, money, the institutions are essential for economic development. They are respectively means of continuous settlement, valuation, and allocation of maturing, enduring, and new promises to pay in the future. That lens for looking at the world is the money view lens, and it makes you see things that are kind of invisible if you're looking through GDP, or you're looking through general equilibrium, or you're looking through CAPM or something like that. A key idea in the money view is that all agents are cash inflow, cash outflow entities, hence the settlement constraint that cash inflows have to be adequate to meet cash outflows. And that polices the mismatch between system-wide pattern of cash inflow and system-wide pattern of cash outflow. From this point of view, if you don't have the cash inflow you need to borrow it, and so the demand for borrowing overnight or short-term interest rate is an indication of how lined up in the global system is the patterns of cash inflow and outflow. And then looking forward, as I say, the system is about overlapping web of promises to pay in the future, which are priced today. The dealer system is involved in pricing that, and the liquidity premia that emerge show to what extent are people willing to put off into the future cash receipts, as opposed to today, liquidity premium, and that becomes a central focus. Both of these things are kind of abstracted from in standard economics and finance, and the kind of agency, the way the system evolves over time from this point of view, is the allocation of credit. The allocation of new credit becomes important, because what you're doing when you're allocating credit is picking one possible future as opposed to possible other ones. You know, your new purchasing power is being allocated toward different visions of the future, and so that becomes a key issue, and a political economic issue too. Where is that credit going to get allocated? Now, I want to emphasize, so that you don't think that what I'm urging here is a kind of neoliberal view of the world, that markets are great, and it's not market fundamentalism. This is rather the idea that this credit system is inherently unstable. Okay, the inherent instability of credit, I put there, that it fluctuates. It expands and it contracts, and that's why it needs to be managed. Last resort comes from the inherent instability of credit. Okay, this is a word that was used by Ralph Hawtrey in his Art of Central Banking in 1932, and so I adopt it as a complete orthodox idea because it comes from central bankers. All central bankers know about the inherent instability of credit, and they know that it's their job to manage that inherent instability. All the way back to Bagehot, that's the tradition that the money view comes out of. So here it is, the Art of Central Banking, Hawtrey, that the central banker is the manager of domestic elasticity and discipline, using credit controls, using interest rate policy, discount policy, all the various mechanisms to manage that inherent instability of credit. The challenge today, okay, is that the system is a global system. And so the inherent instability is global instability. And it's managed by cooperation between central banks. And in particular, the Fed, the central bank of the dollar, the liabilities of the Fed are the best money in the whole world. And so US monetary policy takes, and US international lender of last resort is a central concern. For central banks that are farther down the hierarchy, the challenge is managing their local global interface. And I want to say a few words about that. So here is maybe an indication, there's a measure of the global financial cycle. This is again from the BIS recently. The global cycle has sort of being made up of two elements. One is sort of markets working on their own, the inherent instability of credit, boom, bust, okay? But this is interacting with US monetary policy, which is fighting boom bust to some extent, but maybe with a focus on the US rather than on the global system. And that is then getting translated to the periphery, to the global south. US monetary policy, when it's loose, means loose monetary policy in the global south. US monetary policy, when it's tight, means tight monetary policy in the global south. And we are just shifting from one to the other just now. We've had very, very loose monetary policy during the pandemic, and now we are in a tightening phase. That is that needs to be managed. Here's I spoke before about the hierarchy of money. And here I want to say that that's a hierarchy of institutional hybridity as well, with the reserve currency on the top, mostly offshore private credit, at the bottom, mostly public. So this hierarchy is of institutional hierarchy is where you are in this that determines what tools you have available for managing your interface with the global system. What is to be done? Managing the global interface. I want to emphasize long-term capital flows for development, short-term capital flows for balance of payments buffers, backstops, tying into the backstops for the global financial cycle, which every country is confronted and is exogenous to them. It's nothing they created. And then financial development for moving up the hybridity spectrum so that you can get a little bit more management and economic development. These are the where I would focus attention in improving performance in the global south. I have a few last slides here. Let me look. How am I doing on time? I have 1 minute. So I will just maybe hint here that there is, so here's the famous diagram from Triffin, that this is a way of thinking about the world that in some ways is opposite to a challenge to the mainstream, meaning these sorts of things. But I will note also, and it's been brought to my attention, that there are hints that standard economics is recognizing these facts about the world. Here are 4 papers that seem to me that they want the money view. They don't maybe realize that's what they want. They're moving in that direction. They have a little piece of the puzzle, but it's not all put together. I view these as a sort of vindication of Kindleberger. At the end of his career, he wrote 2 books. They were collections of essays. One, International Money, organized, and I'm just pointing to this organization: Part 1, International Money; Part 2, International Payments; Part 3, International Capital Markets. These are the 3 institutions, right? These are the 3 kinds of institutions that I mentioned. And his Financial History of Western Europe, again, Part 1 is money, Part 2 is banking, Part 3 is finance. So he was because he came from a central banking background, he was inherently a money view of the international monetary system. And he used that to try to think about the future toward a new monetary world order, and to interpret the past that he had lived through, the interwar period and after World War II. I was going to say something about SDRs here, but I am out of time, so I will just finish there with this essential infrastructure for the global system. Let me stop sharing.
Very wonderful. I think bringing together all your skills into one 45-minute presentation, I think, on issues that will resonate, I think, during the summer school as well. So I think it's a perfect way to kick off this year's summer school. We have a number of questions, so I think we have time at least for 3 or 4 of them. So I'm gonna throw these at you, and maybe one at a time, and you can respond directly to the questions. The first one from Ursula: can this system survive the fact that it's completely inefficient at promoting sustainable development? For how long can the decoupling between financial and real performance persist? I guess a little bit back to my issue of the links between the financial system and the drive for investment that we are all desperately needing in climate and infrastructure, particularly in the developing world. Maybe you can address that one first.
Well, that, of course, that's the elephant in the room. That's the big question. And channeling Kindleberger, he was very concerned about fostering long-term capital movement for economic development. And so is Ursula. Okay, that's the idea here. What I think Charlie would point to is that in the last 10 years, since the global financial crisis, basically because in the global north, they were rebuilding their balance sheets and interest rates were 0, this actually led to quite enormous capital flows from the north to the south for kind of the first time. Those numbers are really quite large. Now, was it efficient? Was it allocated to the right things? Probably not. Okay, but this is an opportunity. This is the point. Okay, that the global south, which had been cut out of global capital markets, is no longer cut out of global capital markets. And so there's opportunity here. It seems to me. It needs to be managed. The allocation of credit is the way you choose one future over another. And so rather than trying to sort of stop this and say this flow of capital is dangerous and should be stopped, I would say, Kindleberger would say, this flow of capital has opportunity. Let's try to direct it to productive ends.
Of course, the Marshall Plan, you mentioned, just a follow-up, because Kindleberger was most of the flow of capital took the form of grants in the Marshall Plan. And that's not the case, sadly, for many developing countries today. I mean, that must make a huge difference to that link between the money system and the kind of investments that we're talking about.
So that's interesting point. So the Marshall Plan, remember, was not actually about economic development. It was about sort of recovery from the war. These were European countries that were already developed countries. They had been smashed by the war, but it was about providing the means for them to buy U.S. goods so that they could restock and get their economies going again. That's a rather different objective than economic development of the kind that's faced by the global South. And so I think sometimes the language of Marshall Plan is a little bit misplaced in thinking about that. If you and it was also, these were all official flows, you know, from the U.S. government. It seems to me that the scale of investment that is required for confronting the development challenge and the climate challenge and all those things, the scale of investment is something that's going to require private capital as well as public capital. And so there is going to be an interest rate involved here, but there's a win-win here, you know, that the global North needs, you know, yielding assets for their pension funds and so forth. And so that money is available. You know, it can flow there. And so some version of public flows and private flows, again, you can do this well or you can do it badly. You know, you can subsidize private capital and wind up the taxpayer holding the bag. So how exactly we're going to do this, okay, is the key. And which you bring up, you know, but Marshall Plan, you're pointing out that maybe public capital flows are part of the story as well, and I wouldn't deny that.
There's a question about the underdevelopment of financial markets and systems in low-income countries, which, you know, is a concern, of course, that we have in terms of mobilizing resources for development, and whether that underdevelopment, how that underdevelopment of financial markets in the South relates to your story, perhaps to the rise and role of euro-dollar markets in that. How does that underdevelopment of financial markets in the South relate to your understanding of the workings of the money system?
Yes, so I would refer you back to the slide that showed the spectrum of hybridity. Okay, that spectrum of hybridity is about the underdevelopment of financial markets in the global South. And it has several consequences. That if you have underdeveloped financial markets domestically, you're not able to mobilize, you know, your own savings flows. But typically, these countries don't have a lot of savings flows in the first place. Another concern about financial underdevelopment is that it actually makes you rather vulnerable, you know, to balance of payments crises and to global, you know, external shocks, because you don't have the financial flows in order to buffer that. As I was saying, for a country in the global South, the settlement constraint is the balance of payments constraint is the settlement constraint, that you have to pay in dollars. If you can't borrow dollars globally, okay, because you don't have the financial, then you have to hoard them. You have to build reserves, which is a waste of your own resources, but you need it in order to buffer yourself. As opposed to swap lines, as opposed to borrowing in money markets, which is what countries in the global North do when they face a shock. And so financial underdevelopment has a number of consequences, and therefore that's why I would emphasize. I think it's not true of UNCTAD, as you say, but it has historically been true in development economics, but that all of the focus has been on the real side. Like, we need education, we need roads and bridges, and really financial stuff is bad even. You know, we don't want financial development. We want this all to be run by the government. And I point out that is at the bottom of the international hierarchy. Okay, that is set of institutions is exact opposite of what it looks like at the top. Not to say that these countries should willy-nilly adopt the financial system of the United States. Not at all. Not at all. That would be a disaster. Okay, it's about climbing the hierarchy. It's about step by step developing the markets that are useful at your own stage of economic development. So thinking about where you are in that hierarchy of hybridity, I think, is the first place to start. Okay, and sometimes you hear calls like, oh, we must get rid of capital flows because they're destabilizing. Well, to some extent, that's a call for not having financial development. And so this is I want to just counter that, and say that you're another way to engage with the international system is to figure out what kind of financial system is appropriate for your country at its current stage in development. I think that, importantly, appreciating that the global system is a dollar system, whether you like it or not, okay, and that you need to figure out how best to engage with that, how best to buffer yourself from the shocks that are emerging from that system. Not engaging with it, I think, is not actually a choice, and it's an illusion that you can somehow do it, cut yourself off.
We're going to have to we need to wrap up, Perry, but there's a number of questions. I mean, in your hierarchy, obviously the top dog is the Federal Reserve, clearly. But there's a question about whether it can play a genuine global lender of last resort, given that it is beholden to domestic challenges in the United States, first and foremost, and we're seeing the consequences of that to some extent now, as you mentioned. And related to that, very quickly, because you raised it, a number of people have asked about the role of special drawing rights as an alternative supplement, which I think, interestingly, was what happened in '71. I mean, Nixon and some of the people around him thought SDRs could play a role as an alternative to the dollar. You mentioned that they were trying to diminish the role of the dollar as much as augment it, and SDRs figured in that discussion. So how, just very quickly, if you can give a sense of the SDR story in your picture.
Well, one of the reasons that the U.S. administration was keen on the SDR was so that the Fed would not have to be the global lender of last resort, that this could be somebody else's problem, and that remains true today. The way that the United States supported this expansion of special drawing rights was an attempt to provide another target for the demands of the global South, and to divert that attention to the IMF. The main point that I made in these slides, which I believe are available to all of you, so you can look through them and see the point, is to appreciate that this is very important, because it's sort of against Triffin, is that the way the SDR works, it's basically a line of credit. A line of cheap credit, actually, but it's not fiat money. It's not coming from nowhere. It's not money. It's not an asset that is nobody's liability. It is a liability that is meant to be paid back, and there is somebody who owns it. Okay, and the market maker in SDRs is the person who owns it, who's willing to trade dollars for SDRs, and so the question is, it's still about the dollar system. It's just a different way of being tied into the dollar system through the market, through the dealers. That's what market makers are, which are in the SDR system public entities, okay, which are buying SDRs with dollars, and therefore providing dollars to the people who are borrowing using the SDR system. You'll see in the balance sheet in my PowerPoint that this winds up, the lenders in the SDR system wind up with essentially a portfolio of not very good loans. And that's what you're proposing when you say the SDR system should be the global central bank. And I think that, therefore, it's not going to be the global central bank. The global central bank is the Fed, which you said was opposed by domestic forces. It's really shocking to me. Under COVID, the Fed did all this stuff and no one complained, not one bit. In the global financial crisis, a lot of people complained. What are you doing lending $700 billion to foreigners, US taxpayers' money? This was in Congress. There were hearings, not a whimper about this. So I think it is now accepted for all of our domestic troubles, the notion that the Fed is the global, lender of last resort seems to be politically acceptable in the United States. I'm kind of surprised about that, but it seems to be, maybe just no one's noticed yet because of all the other stuff that's happening. But it certainly has acted that way. Okay, it acted that way during COVID with great alacrity, much more rapidly than in the global financial crisis, and that's why people don't even realize there was an incipient international financial crisis in COVID. But there was. Okay, it's just that the Fed jumped in so rapidly that nobody noticed, and then the fiscal stuff came in after that. It's an evolving system. The institutions are evolving, and even in the last 10 years, this big SDR allocation and the role of the Fed, these are all new things.
Perry, I'm going to have to wind you. I'm getting signals from
I'm sure
from the powers that be. But look, thank you.
Thank you very much.
There's lots of questions that I couldn't raise, which is, I think, an indication of the quality of the lecture and the relevance of the topic. I think it certainly speaks to the next session that we have on the fragmentation of the global economy, the potential, and I would encourage everyone to stay on for the next session. You have to register, of course, for that, which is with Jamie Galbraith and Jayati Ghosh. And I think a lot of the issues that, Perry, you've raised will resurface in that discussion too. So again, many thanks for your presentation. And as you said, the slides, of course, will be available, as will the recordings of your lecture. So thanks a lot to everybody.
There were some readings too that I provided, the 78 Kindleberger thing, and a chapter from my book, and a thing about the international lender of last resort. So those are, I think they'll be fruitful discussion for chewing over later on. So thank you for having me.
Thank you very much.
Okay.